How is everyone doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. So I've covered this topic of unrealized losses in banks' bond portfolios for much of the last year. I've covered it in a number of episodes, but I just wanted to get everybody an update. I saw a great article in Bank Director this last week that was written by Paul Davis from the Bank Slate, and I want to bring that in and share that with everybody here. But before we get to that, I just want to give everybody a little background for people who aren't familiar. So starting from when the Federal Reserve went on their massive interest rate hike cycle, they with the increase of interest rates from 2022 into 2023, it basically left the banks in this position. So basically we kicked off here, I should say, from 2021 into 2022. So you could see, so this is called accumulated other comprehensive income at U.S. banks. So basically this is another way of looking at banks' investment portfolios. And you could see here, so these losses are in the hundreds of billions of dollars. And now this is for the industry as a whole. And so what we're going to talk about in this article here is you could see here, basically it probably hit its peak or the worst part probably in about the third quarter of 2023. It was sitting at 337 billion to the negative, and then kind of dropped down fourth quarter of 23, first quarter, second quarter, third quarter of 24. But then in the fourth quarter of 2024, it spiked back up to 233 billion. Now, as it had trended down to 190 billion, a lot of banks were sitting there basically saying, hey, look, if we just sit tight, this might come back in our favor and it might be okay. But then we saw this spike up here. So what was that driving banks to do? Well, a lot of banks have basically said, maybe we just need to sell out of our position to rebalance our balance sheet, particularly the bond portfolio, and, set us back to so we could hopefully making a little bit of money on that bond portfolio again and setting us up for a better position in the future, because a lot of this has to do with the banks. Look, it plays into the bank's liquidity, plays into the bank's capital. So there's a lot of big things here. And one of the things here with this is that it's fine for banks as long as nothing happens. Like, in other words, you can just hold that bond to maturity. And if you hold it to maturity, you will make some money on it. But if you have to sell it right now at this moment, you're going to lose money on it. And the question, and again, that's fine as long as nothing happens. But if we were to have some kind of, credit deterioration, some kind of market panic, like kind of like what we saw in the spring of 2023 with Silicon Valley Bank, Signature Bank. We have some episode where a couple of banks fail. It could put a lot of these banks in a very bad situation. So banks have come up with a couple of strategies for dealing with this. They've sold off different like insurance units. They've sold off branches to try to raise money. Or some of them have done capital raises, but basically to try to raise money to offset the loss that they knew they were going to take when they sold out of these bond positions to reposition the overall investment portfolio, if you will. So that being said, now this leads us to our article here today from Bank Director, which is called "Banks Have Been Unloading Bonds at a Loss. Is that a good thing?" So with a roller coaster ride in long-term bonds, banks have a tough decision to make. And we read in here, so just as the industry saw unrealized losses in securities portfolios stabilize last year, the fourth quarter changed all that, putting renewed pressure on banks in the year ahead and raising fresh concerns about valuations, mergers, and whether institutions will be forced to sell securities at a loss. Bond yields have been on a bumpy ride. As bond yields rise, bond values fall, sometimes leaving banks with unrealized losses on the balance sheet from previously purchased bonds. Unrealized losses on securities increased by 32.5% from the third quarter and 1% from a year earlier to 482 billion on December 31st, according to data recently reported by the FDIC. The agency noted that long-term interest rates, and particularly the 30-year mortgage and 10-year treasury rates, increased significantly during the quarter, decreasing the value of securities on banks' books. As of March 10th, the 10-year treasury reversed course again, dropping to 4.29%, but rates are still higher than they were at the end of the third quarter. The rates are high, and bank executives and boards must decide whether to hold on to these assets as they slowly mature or cut their losses and remove a worrisome asset from their balance sheet. Though bankers have historically resisted selling securities at a loss, preferring to hold them until maturity. This mindset has somewhat shifted in the past year, according to investment bankers. For over a year now, banks have been shedding securities to create earnings stability and flexibility down the road. The reality for a long time was that recording big securities losses was a dogmatic no-no, says Brian Liebfried, head of bank insights at investment bank performance Trust Capital Partners. There was a mantra to wait for the asset to mature, but if you do that, you will under-earn for a long, long time. Once the dogma was broken down, people became more willing to get rid of assets that no longer served a purpose. We're seeing more people cut loose. Interest rate surge reshapes portfolios. So at the start of the third quarter, the outlook seemed favorable. Interest rates began declining and unrealized losses were starting to ease. However, the fourth quarter changed the landscape again as the 5-year U.S. Treasury yield increased by 83 basis points, ending the year at 4.43%, while the 10-year Treasury yield rose by 81 basis points to 4.61%. Those are massive moves, says Scott Hildenbrand, head of financial strategies at investment bank Piper Sandler, who closely monitors the 5-year Treasury due to its alignment with the duration of most bonds on bank balance sheets. A lot of assets are still susceptible to higher rates, which can lead to bigger losses. The change seemed to overshadow efforts by several banks to go ahead and move underperforming securities off their balance sheet. So the fourth quarter spike in rates was too big of a move for the industry, even subtracting those that had already moved assets off the balance sheet. The increase in unrealized losses has forced more banks to reconsider their portfolio strategies for 2025, convincing some that unloading securities now is preferable to waiting for a sustainable improvement in rates. In recent months, the average securities restructuring has covered only a fifth of a bank's total portfolio as management teams aim to recapture their losses over a short period. Now, more banks are willing to extend earn-back periods to take a more aggressive approach to cleanup. Several banks, including $43 billion Associated Bank Corp in Green Bay, Wisconsin, $3.7 billion Bank of Marin Bank Corp in Novato, California, and $71.1 billion Heritage Financial Corp in Olympia, Washington, have already undergone second rounds of security sales in the past year, with more institutions expected to follow suit. So, more banks move to sell underwater securities. So although more banks may be open to selling underwater securities, the decision comes with significant challenges for management teams and boards. While it can improve long-term earnings stability, the near-term financial impact can be painful. Under regulators' dividend rules, banks can only pay dividends based on their last 4 quarters of earnings, says Chick McDonald, managing director at the law firm McDonald Partners. While banks can average earnings over that period, a substantial loss still puts pressure on dividend stability. Major losses can impact discretionary bonuses, stock buybacks, and may even prompt regulatory consultations. These deals aren't very happy news, McDonald says. The loss has a lingering impact for banks, and nobody likes that. Many banks must also determine how to fill the capital hole created by selling securities at a loss. Several institutions have issued common stock to raise capital in conjunction with securities repositioning, a move that is often unpopular due to the risk of diluting existing investors. Several banks recently sold stock below tangible book value to purge underwater securities, according to data compiled by Performance Trust. Financing with equity at or below book value doesn't make a lot of sense to me. Says the investors are probably getting good deals, but the bank should be thoughtful and consider other ways of bringing in capital. To avoid dilution, some banks have turned to creative capital raising strategies. Notably, $12 billion First Busey Corp in Champaign, Illinois, sold Visa Class B shares, while $972 million Boygoda Financial Corp in Teaneck, New Jersey, and $32 billion Fulton Financial Corp in Lancaster, Pennsylvania, offset financial losses by executing sale-leaseback transactions on branch properties. In other words, selling the bank branches. The decision to cede securities is complicated and ultimately depends on the composition of the entire balance sheet. 2 banks could have the same durations, but the buy or hold decisions could depend on what types of securities they have. And then goes on to unrealized losses complicate M&A deals. The impact of unrealized losses on bank valuations and growth strategies is complex. Securities portfolios matter for M&A activity, where regulatory scrutiny is more pronounced, and in cash deals, where unrealized losses lead to a decline in tangible common equity. A buyer with a big unrealized loss might find it harder to do a cash deal for a seller who also has big unrealized losses. Hildebrand agreed, adding that even stock-based deals may take longer to materialize as both parties navigate portfolio valuations. M&A was about to explode as rates fell in the third quarter. All of a sudden, you're having to re-examine the marks at a time when a lot of banks don't have the equity. It just makes a deal harder to do. More banks may look to offload securities before pursuing a buyer. Just like selling a house, conventional wisdom suggests the bank appears more attractive if it addresses balance sheet issues before an acquisition. You make sure the roof is tight, you clean out the garage, you do all the things you need to do to get it ready. While interest rates have eased slightly in early 2025, the long-term outlook remains uncertain. Some banks are choosing to act now, selling securities to gain clarity and control over their financial trajectory. Any bank considering a major portfolio restructuring should proactively engage with regulators. McDonald says that's a must. It will give your regulators more confidence in what you're doing and why. So, again, this is a huge topic in the banking business right now. And this is, like I said, this is an issue. If I go back to this article for a second, you could see a big part of the reason why banks have considered selling these portfolios, or at least trying to reshape their portfolios now, is because this problem, unfortunately, is not going away anytime soon. And I think you do have to make that decision at the end of the day. Do you want to sit around? Like, in other words, if you're trying to grow the bank, if you're maybe thinking about doing a merger, I think you have to address this before you enter down that path, if you will. You also have to think about, just working with the regulators. Like, at a certain point, the regulators they look at your bond portfolio and they see the performance, and, quarter after quarter, you get about 4, 5, 6, 7 quarters, maybe 2 years down the road. And all of a sudden, they're going to start like, hey man, you guys need to maybe start thinking about cleaning this up, because this doesn't appear to be getting any better. And then at that point, you have some tough decisions to make, because you see the ramifications of that. You may lose bank branches, not in like physically losing them, but you're losing the equity in those branches. If you have to sell an insurance division, you may be, you may be losing some divisions that really make you a lot of money. And then the ramifications on the bank. If the bank has to record a loss, does that jeopardize dividends? Does it, jeopardize bonuses for the employees? Does it jeopardize a lot of things around the bank? So a lot of tough decisions. A lot of thoughtful consideration has to go into these things when they're made. But like I said, this is a major issue in the banking business, and I just want to keep tracking it, and I want to kind of lay these things out for people, so hopefully people could get a little bit better understanding. If you see a bank that you either deal with, or maybe you're just looking at something in the news and you're curious as to, well, why did the bank do this, or why did the bank do that? Hopefully this maybe gives you a little bit more insight as to what is happening and why some of this stuff is happening. So, but anyway, we will continue to follow this situation as it unfolds, like we do so many other things going on in the banking business right now. But I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the other content on the channel. Have a great day out there, and I will see everybody again real soon. Thanks a lot.